Hello everyone and welcome back to these sessions on equity valuation for CFA. Now in the previous class we have learnt about single period dividend discount model. Do you recollect? The current value of the share P0 was dependent on D1 and P1. So D1 was the expected dividend receivable by end of the year. P1 was the expected value of the share receivable by end of the year. Both of these D1 and P1 will be cash flows expected by end of year 1, and you discount it for 1 year to arrive at the present value. P0 equals to D1 plus P1 divided by 1 plus KE. That is what we have learnt. But that worked well when it was a single period dividend discount model. What if the holding period increases to 2 years? If the holding period increases to 2 years, just visualize what kind of cash flows you can expect. You will expect D1, that is dividend by end of first year. You will expect D2, that is dividend by end of second year, and at that point you will sell the share and realize P2. P2 will be the price of the share by end of second year. So D1, D2 and P2. These three cash flows you will be getting if the holding period is just 2 years. If I take holding period as 4 years, what all cash flows you will get? D1, D2, D3, D4. 4 years dividend, that is dividend at end of each of the 4 years, D1, D2, D3, D4, and at end of 4th year you will also get the recovery of the share price, that will be P4. So for a 4-year holding period, D1 will be the first year dividend which will be discounted to its present value using the first year's factor. D2 will be discounted by 2 years, D3 will be discounted by 3 years, and D4 and P4 both will be discounted by 4 years. The discounting rate will be KE. So when you discount it by 1 year, it will be D1 divided by 1 plus KE. If it is D2 which has to be discounted by 2 years, it will be D2 divided by 1 plus KE the whole square. Then D3 divided by 1 plus KE the whole cube. D4 divided by 1 plus KE raised to 4. P4 divided by 1 plus KE raised to 4. That will be the present value of all these future cash flows. So please write the title in your notebooks: multi-period or multi-years dividend discount model, where multi-period is the holding period or multiple number of years will be the holding period. So let us write some important notes over here under this heading. With multi-years holding period, we simply sum the present values of estimated dividends over the holding period and the estimated terminal value. For a 2-year holding period, the present value will be D1 divided by 1 plus KE plus D2 divided by 1 plus KE the whole square plus P2 divided by 1 plus KE the whole square. Now this, as I mentioned, will be for a 2-year period, and thereafter for a 4-year period, the current value of the share, that is P0, how will you determine? D1 divided by 1 plus KE plus D2 divided by 1 plus KE the whole square plus D3 divided by 1 plus KE the whole cube plus D4 divided by 1 plus KE raised to 4 and plus P4 divided by 1 plus KE raised to 4. So I am sure you have understood that likewise whatever be the multiple period of holding, you can simply discount the future cash flows to their present values to arrive at the P0 value. Please write up this whole thing and then I take you ahead. Alright friends, I am sure you have completed writing this whole thing. Now what I have done over here for this session and sessions ahead, some good number of questions I have picked up, not from your style of questions and examples, but from different styles and particularly from CA exams. And these questions, I have picked up 12 such questions, good questions. It will enhance your understanding of dividend discount model. and because these are from Indian CA exams, you'll be finding the values given in terms of Indian rupees, and the name of the companies, name of the investors will be also Indian names. So that doesn't matter because the dividend discount model remains as it is. So let us begin with the series of those questions, getting started with the very first question, that is question number 1. Let me increase the screen size for your reference. Question number 1, let us read this question. It says, dividend paid by X Limited in the current year is rupees 15. Equity capitalization rate, that is KE, is given as 20%. The investor wishes to hold this share for 4 years. At the end of 4 years from now, the price of this share is expected to be rupees 367.25. You are required to determine the present value of the equity if the dividend per share grows at 16% per annum for the first 2 years and 14% per annum for the next 2 years. Now do you notice one thing? This is the dividend paid by X Limited in the current year, means this is D0 and the holding period appears to be 4 years. So you will have to compute D1, D2, D3 and D4 based on these growth rates, and the P4 value is given in the question. So let us learn how to present the solution over here. Because it is a 4-year holding period, you write the equation for the 4-year holding period. That will be the future cash flows as D1, D2, D3, each of these discounted to their present values, and then D4 and P4, both of these cash flows you will be obtaining at end of the 4th year. So when you are finding this equation, we don't know the value of D1, D2, D3 and D4. What we know is P4 value. That means D1, D2, D3, D4 has to be determined, and determining that will be a simple task because D0 value is given and growth rate for each of the next 4 years is also given in the question. D1 will be D0, that is current year's dividend already paid, plus 16%, that comes to 17.40. So when you compute D2, then D1 will become the basis, correct? So it will be D2 equals to 17.40 plus 16%, that comes to rupees 20.184. D3 will be rupees 20.184 plus 14%, that will be rupees 23.01, and D4 will be 23.01 plus 14%, that is rupees 26.23, and P4 is already given to you. Now do you notice one thing? D4 and P4, both of these will be cash flows receivable by end of the 4th year. So the overall cash flow in the 4th year will be aggregate of these two, which comes to rupees 393.48. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and we compute the present value of all these cash flows. So there are 4 years in the calculation. So cash flows for 4 years will be D1, D2, D3, D4 and P4. We have just computed D1, D2, D3, D4 in the earlier part of the calculation. P4 is already given in the question. The discount factors or the present value factors as per 20% discounting rate, which is KE, that is equity capitalization rate, has been stated in the table, and when you multiply these discount factors to these respective cash flows, you will be getting the present value of all these cash flows, and that is summing up to rupees 231.59. Please write up this entire thing and then I'll show you how to make this calculation quickly on your financial calculator. Alright friends, once you have completed writing this whole thing, let us move ahead and look at the calculation to be presented on your financial calculator, that is BA2 plus. Turn on the calculator and then press CF because we want to have cash flow based calculation. You know one thing, whenever you press CF, you need to clear the work that you have done in the past. So for that, press second and then press CEC for clear work. So second and clear work. Thereafter, press downward arrow key once. input 17.40, that is the first year dividend, and press enter. Then you press the downward arrow key twice, 1 and 2. Then you input 20.184 and press enter. So we have entered the cash flow of year 1 and year 2. Then you again press downward arrow key twice, 1 and 2. Input 23.01 and press enter. Again press the downward arrow key twice, 1 and 2. Then input 393.48. Now you should know one thing, that both of these fourth year cash flows, that is the dividend for the fourth year and the price of the share at end of fourth year, both have been aggregated over here, and it is required because your calculator will take one input as cash flow for fourth year. So we have mentioned the cash flow for fourth year as aggregate of D4 and P4, and once you input this, press enter. Then press the downward arrow key twice, 1 and 2. Then press NPV, and your calculator will demand the interest rate. So input I as 20 and then press enter. Then once again press the downward arrow key just once, and you simply press CPT to compute the NPV, and the NPV will be 231.59, which is nothing but the present value of the share. So please write up all these steps and then I take you ahead. Alright friends, once you have completed writing this whole thing, now let me just remind you what we have learned earlier. It was 1 year holding period DDM, that is the dividend discount model to be applied when it is holding period of 1 year. Now this is something that you have already learned in the previous class. You don't have to write this. This is the formula that you have learned. P0 equals to D1 plus P1 divided by 1 plus KE. Now you might be wondering that in spite of now reaching the multi-period dividend discount model, already solving questions on that, why we are going back to this single period? We are going back to this with a specific reason. Let me just help you recollect with one thing, that D1 and P1 were the future cash flows expected by the equity shareholder. KE is the equity capitalization rate or the expected rate of return by equity shareholder, and when you compute P0 through this function of D1 plus P1 divided by 1 plus KE, what you will be getting is nothing but the present value of the share. Now once again I am telling you, you don't have to write all this, you have written this whole thing. So I'll tell you why exactly I again brought forward this point for discussion, and whatever I am providing to you on screen now, that you will have to write. Now we get back to that formula once again. Now why I am getting back to this formula again and again, I'll show it to you in a short while, but I want you to continue to focus on the screen please. Mathematically, if we have understood that P0 equals to D1 plus P1 divided by 1 plus KE, if I cross multiply, what will I get? 1 plus KE equals to D1 plus P1 divided by P0. Now everything what I am doing mathematically, you need to parallelly understand it logically as well. So it should not happen that any formula notation that you are coming across, you should just mathematically only understand. Your understanding should be from the mathematical ground, it should be from the logical ground. So the origin logic of this formula we have discussed. What about this one? From the origin if you want to discuss, it is possible. Look at this. P0 is the money that you are investing now. D1 and P1 will be the money which will be your wealth by end of the year. If I take back that previous example, P0 was what? 276, correct? P0 was 276 and aggregate of D1 and P1 was what? 345. It shows what? If you invest 276 now, after a year's time, it will grow to 345. So if I take that ratio of D1 plus P1, which is the end of the year value, if I take D1 plus P1 as 345 end of the year value divided by 276, which was beginning the year value or beginning of the period value, what I am getting on my calculator, 345 divided by 276 gives me 1.25, means every dollar invested now will become $1.25. Every rupee invested now becomes rupee 1.25 after 1 year. Every euro invested now becomes euro 1.25 after 1 year. So when I say 1.25, that is what? 1 as money that you invested, and 0.25 is the return that you are earning over there, which is resembling as KE over here. So 1 plus KE is 1.25 by that logic. So what will be KE? If I want to compute KE only, what will be KE? To mathematically compute that KE, from this whole thing you subtract 1, right? So mathematically again KE will be D1 plus P1 divided by P0, put the whole thing within brackets and minus 1, that will give you KE, and KE will be of course 0.25 if I am continuing with that same example. Now guys, mathematically again, if you want to include this minus 1 within this fraction where the denominator is P0, how do you include that thing mathematically? Mathematically, it will be D1 plus P1 minus P0 whole upon P0, correct? You can again split that into two terms as D1 by P0, and the other term will be P1 minus P0 divided by P0. Now if I focus on what is this P1 minus P0 divided by P0, P0 is the price of the share prevailing now, P1 is the expected price by year end. If I give you one simple example, suppose a share currently is trading at $20 and the price that is expected after 1 year is $22. So $20 investment in 1 year time, it is expected to become by its price $22, 20 becoming 22. What is the growth rate in the share price? Share price is growing at what rate? Obvious answer would be 10%, right? Without using calculator, you can mentally calculate that 20 becoming 22, it is 10% growth. So logically, it is 10% growth, but mathematically, it is P1 minus P0 divided by P0. So what is P1? In my example recently, what I have given, $22 is P1, $20 is P0. So 22 minus 20 divided by 20 will give you what? 0.1 or 10%. That is what we call as growth rate, and growth rate by formula, it is P1 minus P0 divided by P0. So if you substitute this value of growth rate in this formula, in place of P1 minus P0 divided by P0, you can simply put this small variable G. So what you get is KE equals to D1 by P0 plus G. Now this becomes a very, very important formula in the entire field of equity investment. So please write it up and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and we just rewrite that equation KE equals to D1 by P0 plus G. Now D1 by P0 is referred to as dividend yield rate and G is the growth rate. So please try to understand one very, very important aspect. Why D1 by P0 is called dividend yield rate? See, P0 is the price of the share that you will spend today or invest today, and D1 is the dividend income that you will get after 1 year. So whatever money you are investing now, on that whatever income you will be earning in 1 year, that is your yield. That yield is owing to the dividend, and therefore that D1 by P0 ratio is called dividend yield. Actually speaking, growth rate that is mentioned as G over here is also a ratio, correct? Just some time back I have explained to you, G is basically P1 minus P0 divided by P0. So if G is P1 minus P0 divided by P0, it is also a ratio which indicates growth rate. Now, do you notice one thing, that here K equals to D1 by P0 plus G. It is aggregate of the dividend yield rate and growth rate. That is why under Gordon's model, when you come across the assumptions of Gordon's model, the model assumes that K will always be greater than growth rate, and it is obvious because K has to be greater than growth rate. Why? Because K itself is aggregate of dividend yield rate and growth rate. So K cannot be less than growth rate. K cannot be even equal to growth rate. Someone may argue that why K cannot be equal to growth rate. K and growth rate, if they are same, what will happen to the dividend yield rate? Dividend yield rate will become 0. If dividend yield rate is 0, means the company does not pay any dividend. And if the company does not pay any dividend, Gordon's model won't work on that. Now, what is the linkage of this concept with Gordon's model? I am coming to that part as well. So as I said, the expected rate of return by the equity shareholder is the aggregate of two components, the dividend yield rate and the growth rate. So D1 by P0 equals to K minus G. Look at this. In this whole equation, if I shift this G this side, it becomes K minus G. Other side of the equation, it is D1 by P0. Through this equation now, correct? You can see this. Through this equation now, if I want to find the value of P0, I just cross multiply. So P0 will become the main factor, this other side, and this K minus G will become the denominator over here, where the numerator is D1. So the ratio that you get over there, the equation that you get over there will be P0 equals to D1 divided by K minus G. And my friends, that precisely is the Gordon's model formula for computing P0. Now, do you recollect one thing? Your holding period doesn't matter over here, provided the growth rate is constant. If the growth rate is constant, then only you can apply this formula. So what I am going to do, just to make sure that you do not have any kind of confusion, I will just keep the discussion restricted to certain concepts at a time. I will just put your attention over here with respect to this dividend discount model developed by Gordon, where P0 equals to D1 divided by K minus G, and G over here is a constant growth rate. What happens when the growth rate varies? We are going to discuss those aspects in the later parts of the class. So with this much discussion, I shall put an end to the class. Thank you very much for attending these classes, and see you in the next class soon.